Hi, I'm Drew Moore from Advanced Trading. For over 40 years, we've helped the agricultural community weather the volatile markets caused by local, global, and seasonal events. Every day, our exclusive research team and experienced risk advisors share valuable insights and are sought out by the industry for perspective and market analysis. With over 30 offices in 11 different states, we're confident we will be able to assist you wherever you are located. You never stop working, and neither do we. Good morning, my name is Drew Moore, and I've got Brian Basting and Michael Reginelli in our studio, and we're going to rehash the USDA supply and demand report, usually a very volatile report in nature. We'll rehash a few questions today, and also want to wish our viewers Happy New Year. So first question for you, Brian. Most would construe this report as one of the bigger reports of the year. What was your big takeaway, and what did the numbers say on the corn and wheat side of the ledger?
Well, you hit the nail on the head, Drew. Another volatile report from the USDA today. Probably the shocker today to me, as I glanced over the numbers initially here, was the reduction in harvested acreage here in the U.S. compared to the November report. That was the last survey-based report. We basically reduced harvested acreage, Drew, compared to November, 1.6 million acres. I don't recall that large of a decrease in recent memory anyway. The vast majority of that, Drew, is in the western corn belt between Kansas, Nebraska, South Dakota, and Colorado, was well over 1.5 million acres. So unfortunately for those folks in the west who experienced that drought, it really came to bear in this January report. So what that did, Drew, was reduce the crop size 200 million bushels from what it was in that last survey-based estimate in November. And what it also did was offset a reduction in the export forecast. USDA did cut corn exports in this report by about 150 million bushel. However, that was more than offset again by that reduction in production. They tweaked feed residual down a little bit. Surprisingly, feed residual was decent in the SON quarter. Not great, but decent. Bottom line, carry out at 1.24 billion bushels for corn, Drew, was below trade expectations. So we're seeing a pretty good move to the upside. Briefly, Drew, on the world scene on the corn, they did lower the Argentine corn production estimate about 3 million tons. However, I'd remind the viewers that they increased Ukraine exports by 3 million tons. So just a reminder, this is a supply and demand driven market. And right now we're seeing very weak corn exports, and USDA did acknowledge that today. Switching over into wheat, Drew, we're looking at the domestic market. Stocks on DS1 were a little bit lower than expected, perhaps a bit more feeding or less residual loss, if you will, during that SON quarter for wheat. More importantly, however, looking forward to 23, USDA did confirm today with that first survey-based estimate of acreage that not only did that crop insurance price in July and August encourage more acres, but also just the overall high prices of wheat. We saw soft red winter wheat acreage, Drew, jump up to 7.9 million acres, well above trade estimates. We also saw the hard red winter acreage jump over 25 million acres, well above trade estimates. So again, we're looking at the potential, underline the word potential, for a rebound in production, particularly for HRW out west, weather permitting. But that is our first clue, Drew, that we did plant more in terms of the acreage pie for 23. My last comment is on the world side for wheat, Drew. We did see the USDA basically not nudge down the Argentina crop anymore. They left that unchanged from what it was in December. We are looking, though, at stiff competition from not only Russia, but also near record exports from Australia.
Very good. Thank you, Brian. That's very helpful. Michael, what did the USDA tell us domestically in the soy complex?
Yeah, markets were up leading into the report, although we'd probably shed 8 to 10 cents, still in positive territory when the report came out. I think there were a lot of people leaning maybe a little bit negative. The general consensus was we were going to need pretty friendly, bullish fundamental data to support futures, which are now over $15 to sustain it and to even excel above it. And that's kind of what we got today. Looking at it, the DS1 stocks, at 3.022, a little less than the average trade estimate, tighter stocks as of DS1. But then across the board, production numbers were tighter than expectations. They reduced the U.S. yield to 49.5. Average guess was 50.3, so they took that down a little bit. And then the carryout for 22-23, or the ending stocks, same thing, reduced by 10 million bushels. So 220 to 210, relatively tight carryout looking forward. The one thing I would point out, it feels like, Brian will likely talk about it, but it feels like the USDA has maybe taken somewhat of a conservative approach on South America's crop compared to some of the private analysts that we've seen out here this week and in the past few weeks. Trending in the right direction, but there could be more work to be done there. In general, the average world ending stocks on beans, 103.5. Average trade guess was about 2 million metric tons less than that.
Gotcha. Thank you. Yeah, that's a good segue into my next question for Brian. So obviously weather trends are a big impact on U.S. prices down in South America. What did the USDA tell us for South American production and exports, and what does that look like in terms of economic potential for the U.S. producer here for this year and the next crop year for the U.S. farmer as well, Brian?
As Michael pointed out, Drew, we're looking at some reduction from the USDA today in not only the soybean production estimate, but also the corn production. However, USDA historically, Drew, tends to be conservative in their production declines, especially, and justifiably so in some cases. As your viewers know, we're looking at a very key time period now for pod set and pod fill, for example, in Argentina, and of course, corn pollination in Argentina. So those numbers can still vary. However, it is a very harsh drought that is being experienced down in Argentina right now, Drew. Just to summarize for the viewers, there are some forecasts at this point that are a little wetter for next week and moving into that second half of January. As everyone who's ever watched commodity markets knows, however, we're looking at a weather market that is extremely volatile. Weather can change from one forecast to the next. So I just remind the viewers at this point, Drew, we're looking at some attractive prices from a producer standpoint, not only for any remaining 2022 bushels that are unsold, but also looking at these 2023 crops. And perhaps, Drew, it's not too early to think about 2024. Just the bottom line, in my opinion, Drew, very important for producers as we enter 2023 here to defend their balance sheets. We're looking at some very attractive balance sheets. In many cases, I don't want to forget our producers out west who did struggle with drought in 2022, obviously. But for the most part, particularly as we move further east, some very strong balance sheets in place. Defend your balance sheet. In my opinion, a key at this point moving forward, Drew, would be to get a floor underneath the market, but give yourself some flexibility. If this market continues to want to run, not a price prediction, but just an observation, if it wants to run to the upside via perhaps continued problems in Argentina, you want to be a participant in that, but you want to move up your floor in conjunction with that market. So defend your balance sheet, remain flexible. And again, it's not too early, Drew, to think about not only 23 bushels, but perhaps all the way out to 24.
Agree with you 100%, Brian. Thank you for that. Michael, over to kind of the commercial merchandising side. New numbers, tighter balance sheets, as both of you guys have noted. What does that play out? How do spreads play out from here? March forward spreads in corn and soybeans.
It'd be impossible to say exactly how they're going to play out. It's going to be incredibly dynamic, and this could become a long-winded answer. So I'll try to avoid that. But the primarily less stocks as of DS1 means less supply, less inventory to ultimately meet demand compared to what the market was trying to frame up prior to that. There's a lot of moving pieces that can impact spreads. We saw an uptick in farmer movement last half December, really into first half January to a lesser degree. So the farmer has been turning some ownership over. That's going to play a huge role in ultimately cash prices and how spread performance as the U.S. commercial pipeline gets filled. And higher prices will obviously tend to coax out some additional selling from the growers as we go forward. But Couple other things, barge freight has been weakening. If you look at like the Illinois waterway delivery system that these contracts run on, basis has been fairly high, basically all the way since harvest, still fairly high Feb, March forward, despite this recent uptick in ownership that we've seen. And now that we are dealing with less stocks on paper, it certainly creates some friendliness or some strength support behind these spreads to either drive out carries and or accelerate inverses. And I think that's exactly what you're seeing on the board today.
Absolutely. Absolutely. Thank you for that. Brian, thoughts on wheat as we move forward here, both domestically and globally? What are you seeing there?
The biggest message I can share with viewers today, Drew, is that the U.S. remains firmly entrenched as the residual supplier of wheat to the world. Looked at another way, there is plenty of wheat to be exported from, for example, from Australia. And as long as the export corridor remains intact, that wheat will continue to flow out of the Black Sea. Record exports being seen now from Russia. So the message there, Drew, on old crop wheat especially, is that we are the residual supplier in the world. And until something changes in that respect, either a disruption perhaps in the export corridor or a surprise purchase, maybe from China, we will remain the residual supplier. The other key message I want to reemphasize, Drew, is the 2023 acreage increase. We really did see producers respond last fall. More favorable weather in 2022 compared to the previous year in 2021 allowed that soft red winter acreage to be planted, for example. And also we did see more hard red winter acreage go in than expected out west. I think those high prices, that high insurance price that we saw this past summer did encourage those acres. Now, we've got a long way to go before harvest, of course, but just to remind your viewers, we're still, even with prices weakening in those July contracts for Chicago and Kansas City, and I'd even lump to some degree Minneapolis in the mix, but for the moment, focusing on winter wheat, really want to defend that balance sheet for 23, because with those acreage increases, Drew, if we remain the residual supplier, ending stocks for soft red winter and HRW could increase substantially for 23-24.
Makes sense. Makes sense. Thank you, Brian. Michael, last question for you before we adjourn here. Money flow into commodities. It's going to be a little bit of a mixed bag across the entire spectrum. But as it pertains to corn, soybeans, and wheat, what do you expect here for money flow from managed money and index funds and others as we get into the new year here?
If I had to guess, I think what's most likely is we'll see commodity funds, investment funds, hedge funds continue to reduce exposure to some degree in ag commodities as we work into 2023. Namely, we've seen a lot of money flow out of this commodity market really since last April or May, when there was 60 plus billion, long in commodity exposure. That number's been reduced quite a bit. One of the things that's happened is obviously, we saw the Feds hike interest rates at the quickest pace in 40 plus years. And, we have interest rates as high as we've seen since 2008 currently. And so what that tends to do is move money out of what would be a little more like riskier asset classes, commodities possibly being one if they're considered an inflation hedge, into what you'd call more risk-free investments, short-term government debt, treasury, U.S. treasuries, things of that nature, are providing higher yields or a higher rate of return. So I think as long as that is offered and in place, and that's kind of the trajectory of the monetary policy that it looks like we're going into in 2023, we might just continue to see them scale out or reduce some exposure in commodities, at least for the first 2 quarters of this year.
Sure. No, that makes sense. Appreciate you guys and both of your time today. As we depart here, we've got corn, nearby March corn up 15 cents, nearby March soybeans up 25 cents, and wheat is running around unchanged, it looks like, here right now. I forgot to mention that at the beginning of the podcast. But thank you all for your time. Again, Happy New Year. And if you have any questions, please reach out, and we look forward to speaking with you next month. Have a great day.